Here's a little secret most investors miss. It's not about how much you make, it's about how much you keep after paying taxes. Hey everyone, Tommy Durfler, Sam Rice here on the Lighthouse Wealth Group Spotlight podcast. And today we're going to be talking about some smart, simple ways to make sure that you're getting the most out of your investments and not overpaying on your tax bill. So, according to some studies, such as Morningstar, you'll see that taxes can actually shave off 1 to 2% if you're not careful from your investment returns. So, what are some things you can do just to keep more of your hard earned money? So, first thing we're going to talk about is using the tools that Uncle Sam gives you. And this is typically in the form of retirement accounts. So whether it's a SEP, simple 401k, 403b, Roth IRA, an IRA, the government does incentivize you to be able to fund your own retirement. And they do that in the form of taxes. And whichever retirement account you have, it's basically going to come down to two different tax benefits. You're either going to get the tax benefit on the front side, and then you're going to have to pay taxes on the back end side, or you're going to have to pay taxes on the front end side when you contribute to these accounts, and then you get the tax-free withdrawals, on the back end side. So it's going to come down to those two things. Do you want to go ahead and pay taxes now and get the benefit later, or do you want to go ahead and get the pay the taxes and get the tax benefit later, right? And so really comes down to pre-tax and a Roth portion in these retirement accounts. So the question we always get is, hey, which one should I be doing? And typically what happens is if you have a longer time frame or you're younger, the benefit is going to tilt to go ahead and paying taxes now, right? Because you're typically in a lower income tax bracket, or you have a lot more time to be able to accumulate a lot more earnings that give you those tax-free withdrawals later. On the flip side, if you don't have as much time, or if you're looking to retire in the next few years and you're in a very high tax bracket, you may want to go ahead and get the tax benefit today. And then when you do go to pay taxes, you pay taxes when you're in a much lower tax bracket. So these are just simple tools and accounts that are really available to most people to be able to use these in a very tax efficient way. The second tax tip we have is basically doing what's called a Roth conversion. And essentially, a lot of people can have both of these accounts. They can have tax-free accounts. They also can have pre-tax accounts. Well, what a Roth conversion does is it takes a pre-tax retirement account and converts it over to a Roth retirement account. Okay. Now, when that happens, of course, the government sticks their hand out and says, okay, any amount of money that you decide to convert from a pre-tax to a Roth, you're going to have to pay taxes to the IRS, right? They want to go ahead and get their taxes on the front side when you do a conversion. So, of course, the best time to do that is when you are going from a high tax bracket to a lower tax bracket. So now you're saving on the difference between tax brackets when you then go from a higher tax bracket to a lower one. So you're paying the government less money by doing that. The second scenario in a Roth conversion that we see that where it makes a lot of sense is simply when you have a pullback in the market. So let's say that your account is $100,000 and we have a 20% pullback and now you see that it's $80,000. Well, by converting monies, if you were to convert the whole thing, of course, that $80,000, you'd have to add $80,000 to your income simply by converting it to the Roth. Now, of course, that all depend on a lot of different factors. But in this example here, if you then converted $80,000 to your Roth retirement plan, then what happens is now that money comes back and grows, but it's all tax-free. Whereas if you would have left it alone, you would have had to pay taxes on $100,000, but because the market pulled back and you got a 20% decline, you're able to convert that, go ahead and pay taxes on $80,000. And now that all that money will grow tax-free essentially forever. And so in a Roth conversion, you're timing those things to be able to say, hey, either there's going to be a significant, pullback in the market to where this makes sense now, or for whatever reason, I've gone from going into a high tax bracket to a low tax bracket. Therefore, I'm giving the government less money, when I
Hmm.
do decide to convert that. So obviously, you want to be very sensitive to
Yep.
that because any monies that you convert, remember, you're adding to your overall ordinary income for tax purposes. So you just want to be very sensitive and thought out before acting on that. But in a lot of cases, it does make sense when you're in one of those two of those situations. So, up to this point, we've talked about retirement accounts specifically, but what about non retirement accounts? So, Sam,
Hmm.
tell us a little bit about some things we need to be thinking about from a tax perspective when, let's say, you have investments, but they're not in a retirement account.
Yes. Good question. So, as you said, we've talked about retirement accounts, non retirement accounts. Those are typically individual brokerage or joint accounts. And these have a lot more maneuverability of what you can put into them, what you can pull out. There's no real restrictions, unlike traditional retirement accounts. The one caveat is holding time matters. So the amount of time you hold an investment really matters in comparison to a retirement account, which doesn't really matter at all. And why it matters is when we're talking about gains. So and how those are taxed. So how this differentiates between a retirement account and a non-retirement account is you can put money in a retirement account, trade it as much as you want. You'll never see any taxes until you pull the money out in most cases. On the flip side, in these non-retirement accounts, you're not taxed on any of the money you put in, but you're taxed on the growth. And so the holding period matters is because if you hold it less than 1 year and you sell it, the position with some growth, whatever it may be, you're going to pay your ordinary tax bracket in taxes on that growth and that could range from 10 to 37%, whatever your current tax bracket is. Um, on the flip side, though, if you hold it longer than 1 year, you get knocked into what's called long-term capital gains brackets, which could be 0, 15%, or 20%. And in most cases, depending on your overall tax bracket, in most cases, it's less than what you typically pay in your um, traditional less than 1 year income bracket. So the holding period really matters on those non-retirement accounts. But it gives another really nice avenue for being able to mitigate taxes, mitigate income and cash flows, and gives a lot of just versatility in your overall income and tax situation in retirement and close to it. The other nice thing is that we talked about gains in some
Hmm.
of your positions, but on the flip side, if you have losses, some of those can also benefit you. Like we always think of, oh, losses in a investment account, that's a bad thing, but we can really make the most of them, which is nice at the end of the year. Say if you had, as an example, if you had invested $100,000 and say we put it all in Apple and it grew the amount to 100,000 or 103,000, but you also had another position that was down 3,000, you could sell both of those positions, the gain and the loss, and you'd be at break even for the year and you could pocket that. Um, the other interesting thing is even if you had, say, a $20,000 loss, you could bank that for years to come through your taxes, up to $3,000 per year against your ordinary
Mm.
income even. So not only your capital gains offset, but also your ordinary income, which is pretty nice. The only tricky thing you want to worry about for a lot of the timing of some of these things when we're talking about how long to hold something, how those taxes may change, is if you are looking to take advantage of that tax loss harvesting, one of those losses, you have to at least be out of that position and can't buy it back for at least 30 days, or else it's triggered a wash sale rule, which means it nullifies your targeted loss for the year. So
Mm.
you won't be able to
Mm.
take that anymore. So unfortunately, you got to at least be out of the position for 30 days, and then you could buy it back. Um, but that's a really handy thing that a lot of people use to offset some of their other maybe big gains for other positions in their accounts and something that they can bank on maybe in a down year for years to come. They can keep using that over and over again because they never expire. So that's the really nice thing. Once they're banked with your CPA or your tax professional, you can use them for
Mm.
years to come. And I think that leads well into just your overall asset allocation and just maximizing that. Tommy, do you want to talk about a little bit about that before, some of the year-end tax
Yeah,
tips?
so I think, you get what we're talking about are retirement and non-retirement accounts, right? So in retirement accounts, you typically have some kind of shell or overlay of protection from taxes in one form or the other. In non-retirement accounts, it's really the account itself does not have any kind of tax benefit in of the account, right? So now you have to look at,
Mm-hmm.
okay, well, what are you funding? What type of investments are you funding a retirement account and a non-retirement account in, right? And so there are very,
Yes.
tax efficient funds out there, investments that are tax efficient in of itself. So, we call
Mm-hmm.
exchange traded funds or index funds. So what these are they're essentially a mutual fund, but they're not actively traded, which means that in a traditional mutual fund, you have a mutual fund manager, somebody that's doing all or team that's doing all the picking and selecting of the individual stocks that they want to hold within the fund. So what happens if this isn't protected by a retirement account, well guess what? You own the fund, but whatever this manager is doing inside that fund that you don't always see on your statement, well guess what? The taxes then roll up to you the investor. And so in traditional
Mm-hmm.
mutual funds, they're very tax inefficient because you don't have any control over the trading that's actually going on. But when they, and you carry the holding position as well. So if a mutual fund bought Apple in 1996 and all of a sudden they decided to sell that today, that's going to be a huge gain. And those gains roll up to everybody that's,
Mm-hmm.
has an interest in those mutual funds at that time. So you could buy a mutual fund, you know, and really incorporate some taxes with hardly even owning it for a period of time. So in that case, any kind of
Mm-hmm.
tax inefficient assets, like actively managed funds or bonds. Remember, bonds are paying interest typically every 6 months. You don't have control over that. When they do, it's counted as ordinary income. Actively traded mutual funds, bonds, real estate investment trusts, those are very tax inefficient products in themselves. And that's where we say, hey, hold these in a retirement account, because by holding them in a retirement account, they have that
Yep.
protection by the account of itself. For tax efficient assets, things like ETFs and index funds, or even individual stocks, you can hold those outside the retirement accounts, right? Because to what Sam just explained, in the stock side, you can do these tax loss harvesting where you can realize certain gains and losses, hopefully offset those. So at the end of the day, hopefully you don't owe anything or maybe even get a tax deduction. But you want to own
Mm-hmm.
those where you have more control over that in a non-retirement account. That's where it really just makes sense to own those because again, by the product, these securities and assets, they're either tax efficient or tax inefficient. And so by having a good strategy to hold those in retirement accounts where they're protected, or hold the tax efficient securities or assets in a non-retirement account, that can really help reduce um, a lot of that tax exposure for you. So,
Yep.
one of the things when we're talking about retirement accounts is that every retirement account says, okay, for pre-tax monies, the government hasn't gotten their portion of their taxes, right? And so what happens is in a pre-tax account where you got the benefit on the front side, the government says, well, you know what? At some point, we've got to force some money out of our pre-tax retirement accounts because we haven't gotten our share yet.
Uncle Sam
Exactly.
wants it.
So at 73, you start what's called a required minimum distribution. And Sam, do you want to talk a little bit about how that works and the problems that people run into at that point and maybe
Mm-hmm.
even some
Yeah.
suggestions?
Some mitigation, techniques that we can
Yeah.
use. Yeah. Yeah, as Tommy said, RMDs. So this affects the retirement accounts that got that benefit on the front end. So this would be a traditional 401k and traditional IRA. And once you hit 73, the government makes you start to take out what's called an RMD, your required minimum distribution. And it's allotted to a calculation that the IRS creates each year. Yeah, so anywhere ranging from about 3.5% is where they start, and it's calculated each year on the account value itself. Um, and at 73, they make you start taking that out per year. Why this can get tricky is that if you're already taking out income from pensions, or if you've already started, if you would have already started Social Security, if you have it, this can really add up on your taxable income for the year. So this makes it very important to understand your RMDs, what that liability might be for the year, and how it might affect you for that year. If you've built up these large IRAs, it could push you into higher tax brackets in some cases. If they're making you, say, pull out an extra $40,000 a year, extra $60,000 a year, whatever it may be, you may start to really add on some of that income and taxes to your current tax bracket and bump you up to, another tax bracket entirely, or increase your Medicare
Mm.
premiums, because all of that still feeds back to your income that, affects your Medicare premiums, your taxable income rates. One of the good things what you could do to avoid some of this is years ahead is to start planning for Roth conversions. And that's something that we talk to a lot of clients about if they do have the available cash to pay for those conversions, the taxes on them, because that in itself does also add income to your taxable income each year doing those conversions. But again, having the proper planning really takes the shock factor out of some of these things, and that you're not surprised for it whenever it's the year in which these start hitting. Um, Working with your financial advisor and tax advisor together can really help the great, proper planning
Mhm.
ahead of time to not be surprised with some of these things. But there's a couple other really awesome accounts, and one that's a personal favorite of ours, which is the HSA. Tom, if you want to talk a little bit about that and the triple tax threat
Yeah.
that's got.
So I'm a huge fan of HSAs, health savings accounts, right? And so what they are is they're basically you mirror this with a high deductible health insurance plan, right? And so you have these high deductible plans, and essentially it brings the premiums down for those plans. And at the same time, you can fund these accounts, these HSAs, in that way, if you have qualified medical expenses, you can use those funds inside the HSA to be able to pay the deductible for any of your health insurance needs. And so it's great because you're basically doing an automated savings account for your deductibles prior to meeting the deductibles. So the one thing I like about this is the fact that they have, as Sam mentioned, triple threats as far as taxes go, which means basically you get the tax deduction for any contributions into the HSA. They grow tax free, and then withdrawals are also 100% tax free as long as you're qualified medical expenses. And so you put money in,
Mhm.
you can actually invest in the HSA. So HSA allows for different investments. You can grow the money inside the HSA if you want to. If you don't want to have any fluctuation, you can keep it as cash and accessible. But the kicker is the fact that once you get to age 65, however much you have in that HSA, now you can withdraw it tax free for any non medical expenses. So it's basically
Mhm.
turning your HSA into a stealth retirement account, right? And another quick kicker about this is that essentially, if you have the cash flow to do it, you can fully fund these HSAs, put as much as you can per year because they do have limits to them. You're going to get the tax deduction.
Mhm.
You invest them. And then when you have medical expenses come up, you do not withdraw anything from the HSA. You go ahead and pay for those medical expenses just using your cash, right? Cash flow. And you keep those receipts for any of those medical expenses. And so by doing that, by keeping those those receipts, then at a later point, at any point pre-65, you can withdraw those monies tax-free. And the government says, well, as long as you can match those up with qualified medical receipts or invoices, then that's a tax-free distribution.
Yeah.
Because remember, you paid those qualified medical expenses from your own cash. And so you're basically reimbursing yourself at a later point if necessary. So it's a way for a lot of people to really fully fund and keep funding these things and just allowing these HSAs to grow. And they can be used to pay for long term
Yeah.
care premiums. They can be used for any kind of expense after age 65. And basically, you just built yourself another retirement account.
It's awesome. No time restriction on it.
It's great as far as that goes. And so again, it's as of 2025, it's the only account in the tax code that gives you, that triple tax savings, which that doesn't
Mhm.
exist. So, great way to supercharge your retirement if you have the cash flow to do it, pay the medical expenses outside of the HSA, allow that thing to grow and invest, and it can really supercharge your retirement. Now, there's also certain things you can do from a charitable standpoint to help mitigate your tax situation. And so one of those is donating highly appreciated stock into a donor advised fund, which we call a DAF. So these become very, very popular recently, and it's just basically a charitable trust. They're really easy to set up. They're very low cost, and they're just very easy for folks. And so what you can do is basically if you have highly appreciated stock, right? Let's say you did buy Apple in 96 and you said, well, if I sell that right now, I'm going to have to pay the government a pretty large chunk of money, even at a long-term capital gain, simply because there's
Oh,
so
yeah.
much gains inside this stock. So what you're able to do is you can, instead of selling it, paying the taxes, and then donating it, you can simply transfer that stock directly to a charitable trust or donor advised fund, and you get a tax deduction for the full amount of the security. Okay, as long as you held it for at least a year.
Mhm.
And so there's no selling at that point. You get the tax deduction in the entire current value. It goes into the charitable trust. You can then give it away freely. It sells it inside the charitable trust. There's no taxes associated with it. And so for a lot of people that have maybe a lot of built up gains that they say, hey, I don't want to necessarily take this money or I want to give this away. It's a great way to make sure that they're mitigating and removing that tax liability from their income situation. And so that's, for a lot of people that have non-retirement accounts that have built up a certain amount, it's just a great way to remove those gains. And so a lot of times, another strategy that we help people employ a lot of times is, let's say that they have, a stock portfolio and at the same time, they're very charitably inclined. Well, instead of just giving straight cash, to a charitable organization of their choice or their church or wherever, as long as it's a 501(c)(3) organization, we tell them, hey, listen, if you are going to gift $15,000, let's go to your stock portfolio or your investment portfolio. Let's go ahead and move shares of a value that equates to that $15,000 you're going to give anyway. We will move shares and transfer those shares over to the 501(c)(3) organization. So then we can go ahead and use the cash that you were going to give away and repurchase those same securities that you just gifted. So what happens is you removed the gains, the unrealized gains that you're going to have to pay at some point by selling. We removed that off the table. We went ahead and put you in the exact same investment that you were in, but now you're only paying gains at a higher price, or you're only paying gains from the point you've then bought it going forward. So you completely eliminated the unrealized gains in your
Mhm.
portfolio. And that has been a huge tax advantage for a
Yep.
lot of people that employ that strategy. Now, you also have as Sam mentioned, you have these required minimum distributions, right? Which for a lot of people that are coming up on their RMD is really, really tough because essentially you're forced to take out more money than you may need, right? If you need the money, then it's not a problem. You take it out, right? But
Yep.
let's say that you don't need the money. Now they're forcing you to take this money out. Well, it's interesting that you could do what's called a qualified charitable distribution. And this starts at age 70 and a half. Why 70 and a half? I have no idea. Take a wild pick at the government, right? 70 and a half. But instead, you say, listen, I want to go ahead and instead of me taking any of this money or waiting till required minimum distribution age, which for most people is 73, you can go ahead and start directly sending a check from your retirement account directly to the 501c3 organization of your choice, and it will not be included in your income at all. So a lot of people say, well, I do that anyway because I can take money out of the IRA. They just send me the check and then I can write the check and then, I still get a deduction for that. Yes, you do, but it's not as great of a benefit if you did not include it at all. So by not touching the money and having the custodian of your retirement account give that away completely, you are getting a better tax benefit by doing that than taking the money, turning right around, writing a check, and then being able to deduct it from your taxes. So confusing a little bit, advantageous, absolutely. It's what's called a qualified charitable distribution. So speaking of giving money away, a lot of people don't understand that you can actually give money away to people up to a certain amount. And at the same time, obviously a lot of people get confused on, hey, do I have to pay taxes? Does the receiver of this have to pay taxes? So, I know, Sam, you've had a little bit of experience with this, with dealing with some people on this. So tell us what that looks like.
Yeah. Good point. And this is a big thing, especially, grandparents think of this. I think many times towards Christmas, that kind of thing. What can I maybe give to grandchildren or kids? Right. If they're not spending their own retirement money and they seem to have excess, but they want to, transfer wealth to the next generation, a fantastic way to do it is just utilizing your annual gift exemption or exclusion. So a great way to transfer wealth to the next generation without having touching your very high lifetime estate exemption, which a lot of people have questions about. You still have in 2025 $18,000 per person you can gift to somebody of your choosing. In many cases it's family, but it doesn't have to be. So for husband and wife, that would be 36 you could donate to one person because it's 18,000 per person to donate. So a lot of people, I think, hesitate a little bit on some of these numbers, how they affect your lifetime estate exemption, how that all works. But it's a very high number. And in many cases, we're not close to touching that. But it's good to know that you have that availability at 18,000 per person. Great for funding 529 plans for grandkids or kids. And it doesn't reduce your future lifetime estate exemption. So as long as you stay under that number, you can keep doing that each year without affecting that number. So a lot of people have questions on the $18,000 per year. And I think just a good place to start would be asking us as your investment advisor or asking your CPA, just the effects and the availability for those funds to be gifted to the next generation. And in many cases, there's a couple of different ways in which you can do it and fund a custodial account or a 529 account and keep that money growing for your kids or grandkids in the future. But just to wrap that up, there's some great ways to give money away, still be tax advantageous. But it's just good to know all the ins and outs of the different accounts and different ways in which you can utilize that. You want to close it up?
So just to recap, being a CPA and being in this business for 17 years, you got to be careful of taxes.